Hey everybody, welcome back to this week's video on selling options. So over the past 2 weeks, we've gone through cash secured puts and covered calls. And if you haven't seen those videos already, I highly recommend you pause here, go back, watch those, and then come back and continue this one. Because the wheel strategy is just simply the combination of those two strategies, selling cash secured puts when assigned, selling covered calls. So either way, let's go through this one. And as always, please let me know in the comments if you have any questions, and let me know what you want me to do for the next video, because I'll start diving deeper into different elements of this strategy and how we choose strike prices and looking at delta and the different Greeks. So let's go through this. Ultimately, the goal is always to have your shares and your cash, whatever it is in your account, collecting additional income. So that income in this case, just like cash secured puts and covered calls, additional income is premium. So you, as the option seller, you are selling somebody else the right to purchase your shares or to sell you their shares, and in turn, they give you a premium. So that is really the exciting thing about this strategy, both selling cash secured puts, covered calls, and overall the wheel strategy is that you always should be collecting additional premium, additional income. So whether the market's going slightly down, slightly sideways, slightly upwards, you always should be collecting that additional premium. And that really is the goal here of this strategy, and why I personally choose to do this for a small portion of my portfolio. About 10% of my overall portfolio is always allocated to selling options and the wheel strategy. So first, let's start with cash secured put. We've already talked in past weeks about cash secured puts. You have cash, you decide on a stock that you would like to purchase if it falls to or below a given price, and in turn, you collect that premium. Once it falls to or below that price by the expiration date, you are assigned those shares. So at that point, you own those shares. Then last week we spoke about covered calls, which is what you do with those shares once you own them. You simply sell somebody else the option to purchase your shares from you at a price by the expiration date if the stock hits that price or goes above that price. And now the wheel, it's not a third strategy, it's just simply the combination of those two strategies back to back. So here's a better visualization of the actual wheel strategy. So if we start over here on the right by selling a cash secured put, ultimately, let's say, well, you're going to use Reddit in the following slides as this example. If you're starting with Reddit and you would like to purchase Reddit if it falls to a certain price, you already have that cash allocated. Once it falls, inevitably falls to the price that you are selling the cash secured put on, you get assigned those shares. During that whole waiting period, though, you already have that premium in your account. You were already given that premium by the option buyer, which is great. You could use that premium to purchase additional shares, just to have in your account, invest it in something else, whatever it is that you choose to do. This is never financial advice. At that point, you're holding the 100 shares. So what you then want to do is you can sell a covered call. So again, you're just going to sell somebody else the right to purchase those shares from you. So at that point, inevitably, hopefully, if it's a stock that you believe in, it's going to hit that price eventually, and your shares will get called away. But in the meantime, you also still get to keep that premium. So every week or every month that you're selling these covered calls, you get to keep the shares in your account. You're also collecting a dividend if it's a dividend paying stock while you have those shares, and you're collecting premium. So it's an awesome situation. And then at that point, inevitably, the shares will get called away and you're going to be holding cash again. So you end up being given the cash for those shares based on that strike price that you agreed upon, and you get to keep all that premium. So you end up walking away with more money than when you purchased the shares originally. And then you just repeat the process. So let's go through step one here, selling the cash secured put. Again, this is picking a stock you would genuinely be happy to own. You are going to then choose a strike price below today's price, then set aside the cash to purchase the 100 shares. And the two ways that this ends, either one, it stays above the strike price, and that means the contract expires worthless. You get to keep the premium, and you still have the cash, and you just go ahead and repeat. You sell another put. Or it drops below that strike price. You are assigned, and your cash buy is the 100 shares at the given strike price. Either way, premium's already there. Again, going back to some of the things you want to be careful for here is the key to a successful wheel strategy only sell cash secured puts on stocks that you are happy to own and have the cash available to purchase. We're not going to go into margin selling here. We're not going to go into borrowing against your account or anything like that. That is a way to make additional income, but that's where it's not for beginners. That's where you really need to spend time getting to know the strategy first and understanding how it works prior to taking on that type of risk. So step 2, selling the covered call. Again, you already own the 100 shares and you're going to sell a covered call against it. Then you're going to choose a strike price above your cost basis, never below it, and you're going to collect the premium and just sit and wait. 2 ways this ends. 1, it stays below the strike price, expires worthless, and you get to keep the premium and the shares and you sell another covered call. Or it rises above the strike price. Either it hits that strike price or goes above it, and it gets called away, and you go back to cash. And then you just go right back and repeat the cycle over again. So the nice thing is you're collecting premiums on both directions. Not only both directions, but also if the market consistently stays flat. And again, in this case, the key to a successful wheel strategy, in this element of the strategy, is only sell a covered call at a strike price above its cost basis, so above what you purchased it for, and at a price you're willing to let go of the shares. So let's talk about Reddit in this case. So Reddit is one of the ones that just had earnings this past week, and they had a pretty nasty fall off afterwards. It was a 21% post-earnings drop, and immediately the following day, I knew I wanted to sell cash secured puts on it, because if you had 21% fall off and the company didn't implode, it clearly was an opportunity for it to rebound slightly and capture some of that recovery. So I started off by selling a cash secured put. So I sold one cash secured put for $120, meaning I needed $12,000 in cash. I sold it for 30 days out, and the premium collected was $350. So that's pretty awesome, because that's 2.9% in 30 days if I wait until the expiration. Let's say I do get a sign. Now this is futuristic here. So say that Reddit closes at 115 on the day of expiration. I'm going to purchase those 100 shares at $120. It's going to cost $12,000. The cost basis is actually going to be lower now. So the cost basis is not going to be 120. The cost basis is going to be 116.50. Reason being, it takes that $350 of premium into account. So that's cool, because if you continue to sell covered calls on this now, it's actually going to lower your cost basis. I'm not going to sell a covered call for less than what I actually paid for it. So it's not even the cost basis of 116, but I would never sell it for less than 120 because I do want to capture some of the upside on it. So then moving on to step 3, selling the call. So let's say that I'm assigned those shares. I have it for 116.50, but now I want to sell a covered call. I would sell it for 140. Again, the premium collected, depending on what the current implied volatility is, will be about $300. So again, it's going to be about 2.6% of the cost basis. So 2.6% return for putting up my shares for 30 days is really not bad. And then the end of this strategy would be, inevitably, when Reddit does go back above that 140 strike price, I will then sell the shares for $14,000, which means that I ended up making $2,000 between the $12,000 acquisition price and the $14,000 sale price. So for this example exactly, that's a $650 premium plus a $2,000 gain. So it's $2,650 then back to cash. So definitely not a bad return. So let's talk about what can go wrong. So I was talking a little bit earlier about the wheel strategy and how it's not like it's a perfectly safe, like nothing can go wrong strategy. The premium is small, the risks are not. So let's talk about if the stock keeps falling. So say that you own 100 shares, again with Reddit, and you acquire it for that 116.50 cost basis, but Reddit trades all the way down to 85. At that point, you're just holding on to it. You can't really sell covered calls on it. But if, again, you're following your strategy and you're only selling cash secured puts on stocks that you want to own, heck, I mean, it means that you just purchased Reddit stock at 116.50 instead of purchasing it all the way up at 140 if you purchased it the day you thought about purchasing it. So again, as long as you have the cash and you're willing to sit on it, you're willing to ride it, then it's not a bad deal. Alternatively, what could happen is the stock could rip higher. So Amazon this past week, for example, absolutely ripped after they had an awesome earnings. So at that point, say for Reddit, you sold the 140 call and Reddit recovers all the way back up to 200. That means, unfortunately, you're still selling for 140, which means you lost out on $6,000 of upside. But you're doing this for income. You're not doing this for growth. Like, you're doing this for that actual premium that you're collecting. You're not doing it for the underlyings to grow. So what I personally do is, as soon as I collect the premium, I always end up reinvesting the premium right back into the underlying stock. So at least in this case, like with Amazon, I had a couple hundred shares of Amazon. I had some called away, but I still have a couple hundred shares of Amazon left, many of which were purchased by wheeling Amazon for the past couple of years. Finally, let's talk about taxes. So clearly, I'm not a tax professional. This is not tax advice, but something to look out for, and I personally have been bitten by in past years, is wheel premiums are usually taxed as short-term capital gains. So finally, let's wrap this up. So why does the wheel strategy work? The thing about the wheel strategy is that it's actually paying you for your patience, and it's paying you to put up capital or your shares, but it's not paying you particularly for being right about the next move, which is super cool, because if it goes down slightly, you win. If it goes up slightly, you win. And if it trades sideways, you win, which is really cool. That is why I personally prefer the wheel strategy. Again, I only do this with about 10% of my overall portfolio. I only do this on stocks that I want to own. And I definitely never sell covered calls on stocks that I'm not willing to give up, stocks that I want to hold for the long run. I'd love to hear from you in the comments, or reply with the ticker and the strike that you're looking at, and I'm happy to run the numbers for you. Again, not financial advice, but I'm always happy to talk about options, share more information, and in future videos we'll go into more of the Greeks, what it means to be selling at a 20 delta, how I choose my strike prices, and we'll actually go through the options chains. So please like, subscribe, follow me on Substack, and thanks for watching.